Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on stock charts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed for more information intra-week. Okay, so we got ourselves a really interesting conundrum. And I missed last Friday, and we gave you the recording from the Wednesday before. And I went to the CMT Association conference, and everybody was bullish, raging bullish. And so, like, there was hardly a dissenter in the room. There was only maybe two people that spoke about some cautionary things. And again, you're hitting new highs, so everybody wants to be bullish, but we're also up 23%. So it's not really a place where I want to start thrusting my enthusiasm around. So history rhymes, and I can't help but think that we're sitting here right near the edge of the precipice. Got just so much data lining up. So anyway, today what we're going to cover off is if a person was to look at an advanced decline line, what would they be looking for, and try and improve that. So what I want to show today, just working through these charts, is I'm going to start. This is the NASDAQ in 2000. And it's important that we at least know what we'd expect to see in order to see it live. And so today I'm going to focus on looking at how the markets topped in 2000, not from the perspective of the actual market, but more from the perspective of some of the indicators. And I'm going to specifically focus on the advanced decline line, the net new highs, and I'm going to show that across three markets. And then I'm going to show you some other charts that are just really, really informative. And let me give you one example, actually, before I start there. I'm going to start here with JP Morgan. And so this is currently JP Morgan, and you can see a gentle to flat sloping 200-day moving average or 40-week moving average rolling over, just continually testing it from the underside. If I click on this one, this is JP Morgan from 2007. Does this movie look almost identical? So here's the chart. Gently holding the uptrend, now gently not holding the uptrend, relative strength starting to decline, relative strength declining, and then here's 2000, here's JP Morgan, just gently wandering as the 200-day moving average rolls over, and this is around 2001. So the point I want to make is one of the biggest banks in the world is set up the same as these three tops. Now, why would I just pick those three tops? You could say, well, those situations have probably existed at other times, and I would fully agree with that. The big thing that has changed now is the bond market setup. The bond market setup has given us clues on the 1 year, the 2 year, sorry, on the 3 month, the 1 year, the 2 year, the 5 year, the 10 year, the 30 year, the 3-10 spread, the 10-2 spread hasn't touched zero yet, and then the 30-10 spread. So lots of signals coming off the bond market that make me ultra cautious. Most of the bond market has hit new 52-week lows in yield. My work suggests that's where to look for a top, not so much when these other charts invert, but I've covered off the bond market quite a bit. So I want to show this advanced decline line setup and show what happened here. So let's remember that on the NASDAQ, we had all of these stocks flaring up to big highs. We had companies trading, multi-billion-dollar asset valuations, and they had no revenue, and they had basically a business plan on a slide show on a PowerPoint format, and that was it. And they were raising money to do whatever. One was Global Crossing. It was going to put fiber optic cable around the world. There was all kinds of different companies. There's grocery online companies. There were a company, JDS Uniphase, was a company that sold hardware to the telecom industry, and it used fiber optics. And that company went from $2 to $1,000 and all the way back to $2. So this was heyday. If we thought the marijuana stocks were on a big ride, that was nothing. It was similar to Bitcoin in that it just literally went ballistic and then pulled all the way back. So here we sit with the NASDAQ. And again, March 2000 was the top on the NASDAQ, but it was not the top on the S&P. Actually, the top on the S&P came in and challenged it in September, and the NASDAQ did as well. It came back and tried to break out here. But what you see is the NASDAQ was already in decline in terms of advanced decline line, and it typically has a negative bias over a long period of time. But this was not a negative bias. This was literally getting less and less and less and less and less almost every day. So less stocks advancing than declining, and this was on a big rundown. So after the run into the March top, literally the advanced decline line had some sort of a 2-month trend line here and started to break down. And as it broke down, that was a really good place to be aware of. So as we roll, I'm going to stay with the NASDAQ and the advanced decline line and just show you what happened in 2007. So in 2007, we had this big wedge form early, and then in July, we had a big market pullback. And then we had about a 3-month rally. And we got to around the 9th of the month here in November and pulled back. Now, the S&P topped on October the 9th. The NASDAQ made it through to the next month, broke the uptrend line, and at the same time, we started to see weakness on the advanced decline line, but it didn't make it back to the prior highs. It made lower highs. And then we had an uptrend, and then all of a sudden, if you wanted to, wait right until this far end here, it really started to let go. And in the meantime, the moving averages had started to drop again. So really a difficult period here where the NASDAQ was obviously letting go. And this decline in here was only about 10%. So from 2,700 to 2,450, 10% decline, then a good 3-month rally. And this is like literally straight up. And you can see market got cautious and then rallied out to a new high for, roughly 10 days, just kind of pushed it on, or maybe a week, higher, ran out of steam, came back, tried to stay above this, and then broke the trend line and the horizontal support and resistance at the same time. In the meantime, we had gone negative on the EMA. So now let's go to the next period, and that would be today. And what I want to show today is that the NASDAQ has, so we had a negative advanced decline line slope in June, July, and August. And as we know, the stock market went on to a run to top out in September. So here's the NASDAQ composite, and it topped, this is daily close, it topped out late August, and then September basically treaded water sideways and got this uptrend line. And we started to get a lot of lower, if you took the moving average of an 11 period advanced decline line, by the end of September, things were already dropping down. And you can see this big bump here looks relatively bullish as you're breaking out, and then all of a sudden there's just no meat on the bone. And so what I noticed here is we have this big gap between the September high and the April high, even though price is back testing the same area. And so a lot bigger decline. And then here we had kind of a wedge forming, much like we had here. So we had higher prices and we had a declining wedge, and then we went on a final run. And right now, this advanced decline line just made a little bit of a top above the prior high. And I'm not trying to top tick. I'm just saying there's a lot of setups here with this advanced decline line being so significantly under the prior high. And again, we're just wandering here. So if we start to see this trend line break, that would be a pretty good place to at least be aware of the potential for a major top. And again, it's the bond market, and it's JP Morgan, and it's the Nikkei and the DAX and crude oil. And there's just like a host of items that are all lined up here at a similar setting. And then we go to the New York composite. And this was quite different because the New York composite, you can see in 2000, here was the NASDAQ high. And the New York composite went on to make this higher high in September and break this big uptrend line. And then that was its high. But as you can see, if you got whatever, if you thought you were brilliant and wanted to short the market here, you were literally sitting right in a table with the rest of the market for a long period of time. There was no real gains made over almost an entire 2-year period, with the exception of about a 1-month rise up and then a drop back down into the range and then just chattered along. And so what did the advanced decline line do? Well, it was dropping all through the period going into the March high and then literally went sideways. Now, one of the things that did happen was it started to make a big upslope heading into the final high, and that upslope was probably one of the best triggers to help get you out, because obviously we were a lot lower at this high in terms of advanced decline line than we were here. The market was higher, but advanced decline was a lot lower. Heading into 2007, so again, 2007 was an interesting year because it had a shock late or early in the year. Then in July, August had a bigger price move down. Then we rallied up in September and kept going right into October. And then October made a high. And what we saw is in late October, another retest of the high, and some of the markets performed better than others. But what we saw in 2007 was we had this New York advanced decline line basically going sideways, broke that in July, rallied back up, and while it was going to new highs, we had a gap here, sitting here, and this trend line broke. And so when that started to happen, this was important, and I illustrate this because this feels a lot like the NASDAQ current setup to me. But what we see here is the New York composite on this final high didn't make it to back up to the advanced decline line, didn't make it to the 2 prior highs, but kind of got up into the range. But this trend line, once again, was an important place to look for support. Okay, so here we have the current situation. And again, we are testing the prior highs on this down-sloping trend line. We're also testing the September top. Again, this is the New York composite, so all the stocks are in the New York stock market, and some people might say composite. Sorry about that. Composite is how I say it. Anyway, we've got this horizontal trend line here, and what you see is back in September, we had the same sort of setup where we had horizontal trend line, just basically got barely above it, couldn't quite take out the prior high, and then rolled over. And there was an uptrend here to be respected, and the same thing on the New York advanced decline line. And in this case, again, the top was a marginal difference, but probably one of the better clues was that the advanced decline line was breaking. Then we went obviously down a long way, rallied back up, and that gets us here. So now, in this case, the New York composite has an advanced decline line way, 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 way higher than its prior high. And so this looks extremely bullish. And I think that's one of the things that, is really hard to say that this is not a bullish scenario. I would just say that because of everything else that lines up worldwide, I think it's an important place to be cautious. And I don't think I'd want this upsloping trend line on the advanced decline line to break. And so we get JP Morgan's numbers on Friday. Again, I've illustrated on the arrow here. This market topped out in January, which is an earnings month. It topped out in October or September, October, right in here. And October is an earnings month. And here we are heading into April, and it's another earnings month. So I would just remind people that there's a lot of reasons for the market to be checking itself here. And this advanced decline line is sitting kind of in the middle of the range. And so while it's definitely not a bearish chart yet, all of these trend lines are in place. And I would just say that we want those to hold in a big way. Okay, so let's go look at the high-low. And again, I find the advanced decline line not as valuable. And one of the reasons for that is all of the ETFs kind of push them up together. So this is the NASDAQ in 2000. And look at how high the NASDAQ high-low moving average was. It was literally soaring into the first part of March, and the stock market topped right with it, and then it went straight down and unwound, and this all kind of came tumbling down. So one of the big clues we had was the stock market was having trouble making higher highs. We were making roughly 100 net new highs per day, which is bullish. You know, the market's climbing. Then all of a sudden it went on this huge super surge. And we saw this in the advanced decline line data, came all the way, or sorry, in the net new high data, came all the way up. And this looks very, very bullish. When it started to break down again, this was a very cautionary place. And then you had these rallies, and you couldn't get above this 100 level. And so, that period in the market for the NASDAQ was very, very odd. And that was just because you had all of these unknown companies with literally business plans on paper, not much more, filing an IPO, raising money being thrown at it blindly, and then all of a sudden when it was over, it literally came down, and we couldn't get any more than 100 net new highs, and this was a really important clue that the market wasn't getting healthy yet. So you had an uptrend in net new highs, basically got to 100, stalled, and this was actually the final high. So just as you rally up to these points, it's probably a more important place to check than anything else. So here we go to 2007. And again, this was more about a housing issue and a mortgage finance issue. There was lots of things going on in here. And so the market was rallying really high all the way up. We had lots of new highs and big broad market advance. So we're getting 100, 200 almost every month. We're living above this 100 level. And then we pull back, and then in September, October, we run up and we get to this kind of final high and literally collapse back under it and break a trend line in net new highs. And all of a sudden, down it goes. And so you wonder, are we going to, is it going to rally back up? But look at this area in here. And what we can do is just grab this slider. And the point I want to make was, here's 2007. This is your final high. And then we had trouble making any net new highs for a whole year and a half. And then as we finally came out of the lows, and we all know the lows were in March of 2009, then all of a sudden we bumped up and we started to make a lot more new highs again. So it's that kind of thing that I'm looking for to reverse this market. And so we're sitting all through this period in here, we had very weak net new highs on the NASDAQ. Looking now, what do we have? Well, we can't get above this 100 level. We're stuck sideways. And so one of the things I would expect when we're getting so close to the prior highs is that we start to break this out. All of a sudden we should get 100 or 200, and I'm surprised we haven't with all of the bullish euphoria. But basically we're sitting here at around 23 and just barely hovering above the zero line. So, well, it can still rise up, and it can rise up for a while. I think one of the bigger indications here is if you start to break this upsloping trend line. So here was the actual stock market, and here's the stock market. And then this area chart in the background is showing a moving average, and I've just picked an 8-period moving average. But you can see we really haven't had a whole lot of thrust, not like we did for the big rallies prior. And again, so we've had this big weakness and we've had this sideways move. So it doesn't look to me like there's enough enthusiasm in the market for net new highs here. Going to the New York composite. So what we see is the net new highs, the high-low data. In the background here, you'll notice this red line, and this was a triple top in the New York composite. And if I put the line on here, it briefly just broke out above it, and that was your final high on the New York composite, going all the way back through. And of course, this is the 9/11 spike down, but the market was falling away well before that. And as it was falling away, this was an important thing to be aware of. Now, we had quite a few net new highs, but on this final high in May, we had a sudden spike, and we just barely got above this trend line and rolled over. So to me, that was pretty concerning. And when I look back, I wasn't an active trader at the time. And then when I look back and you see this net new high data, this still looks relatively bullish. But even in that bullish scenario, we struggled. And then by September, we had lots of, we had this big pillow of activity that made the net new highs look pretty good. And literally, it really started to release in this period in here. So while it looked good, look at what the stock market was doing. It was letting go because we didn't have enough net new highs to kind of hold the thing up. Now we go to 2007. And here what happened in 2007 is we had declining net new highs all the way through the year. So we had this big bullish push, fully agree with that. And then by July, we were starting to whimper and the market pulled back and then rallied up. And then we had a nice big move up, roughly 3 months long. And we got into the top here. And as we got to the top, we got to kind of maximum net new highs and a little bit of a push up. And then that marked our final high. We went back to retest with less highs and then we unwound. And again, if we just pull the tape open here and now open the chart, what you see is, that was a pretty good clue that things weren't getting great. And we, in hindsight, you can look back and see these big spirals down as a concern. And what you don't know is it going to continue? So when I look across here and I see the high-low data currently, we still have some. We don't have much. We have about the same as we had in June, July, August. We're barely above the 100 level. Right now, we're around 50. And so again, we're just wandering. We're not getting these big super thrusts where we're getting a lot more bullish activity. And so to me, it feels like the market's running out of speed. And again, it's as it tests this prior high neckline like we saw back in 2000. So very concerned about the lack of net new highs. Now, those are both U.S. markets. And so let's just take Canada because Canada is economically sensitive to the U.S. markets. What we see in 2000, we had a company called Nortel, and they ended up being 33% of our stock market and actually crashed to zero in terms of market cap. So it was a pretty big deal. But what we saw all the way into 2000 was the Canadian market was declining long before the market top. And so this divergence here where Canada is significantly underperforming, even by March, this was a pretty important place. And then we saw one final stab and it went up again, another 10%. And then when this trend line broke, it was time to leave. So the advanced decline line really had been, it would have been too early to get out just on that one, but it would have been over a year. The market goes on to rally. In 2007, this is a really interesting case. So what we see here is in 2007, coming into the June high, we break the advanced decline trend line, we make a lower high, and then we make a higher high here. But on the rally, subsequent rally, we just didn't get any sort of steam, much like the NASDAQ currently. And then we fell away from there. And so we had this rally, and again, roughly 3 months long, where you go back and try to test the prior highs. So we've been rallying for 3 months, and we actually got back to the highs of 6 months ago. And what we're watching for now is, do we have the commitment to get finished? And in this particular case, whether you used a horizontal or some sort of an upsloping trend line, either way, it was kind of telling you that the market was getting weaker and weaker. So we want to be aware of that situation. So what happens in late, so that was this first marker, and the market literally fell down. And then in 2008, oil went to $140. So all of a sudden, the Canadian market shot up, following the price of oil up. And look at what the advanced decline line did. Nothing. It was going the other way. And then for this 3 months here, there was no new net advancers. Basically, the market was flat, or in terms of advanced decline, it was flat. But the stock market roared higher, took out the prior highs, tried to hold it, and then let go. And obviously, we know how far down it went. It was a pretty big thing. So anyway, this first breakdown in the market was pretty interesting because it looked like it would roll over with the rest of the U.S. And then we had one final push due to oil. Okay. Coming into the advanced decline line now, we have a huge gap here in terms of highs as we are right up against the prior highs, and we're nowhere near the prior highs on the advanced decline line. So to me, it tells me there's just not enough participation. Okay, one more look here is the high lows, and this is in 2000. And again, we were trying to get above 50 actually in Canada is a good number for us. And you could see the market was really choppy. So this high-low data was very difficult, but in the periods when it was below zero, it was a great place to be cautionary. Going into the high lows for 2007, 8, and 9, what you saw here is we had this really flat period where we really just didn't matter what the market did, it was climbing, but we couldn't get any sort of big thrust going. And then in 2007, it pulled down, and then we struggled to get any sort of real momentum going after that. And again, broke down. This is the stock market high and stayed down here below. So this was a very extreme case. And again, you can rally as long as you're above zero. The real question is, if you're not getting enough growth to really push the market higher, can you break out of this range? And so here's this 40 level. Again, just trying to take a look at see what would go on here. What we saw is a real big pullback in, and here's September where we're staying below this zero level and really can't get going. So the stock market topped in Canada in July, just as soon as we made our first tick below zero. And we're holding up with 13, but again, we want to see 100 net new highs, especially as we're testing the prior highs. And so we're just not getting that sort of enthusiasm. So all of that lines up to me to just, reiterate caution. And again, you don't want to call a top within days of the top. What you want to do is watch your indicators to see if you have the strength to continue higher. And so we were up almost 8 days in a row, and I think the volume was declining. We're below average volume, which I don't think is a big deal, but probably more importantly is, if as we break out to new highs, new money doesn't enter and we don't start to get more volume, that becomes problematic. So what we're looking for here is if the market can rally, this would be very important. Well, I did an article yesterday using EWJ, and this shows the Japanese stock market. And what you see here is just kind of rounding top intraday, but we're stuck right below the 200-day moving average. And if you go back and look on the weekly charts, you'll find that when the Japanese market stalls around the 200-day, that's a pretty important place for us. So we're here. Now I can do this on crude oil. So if we just go to, won't get an intraday chart, but we'll get a daily, and we're right around the 200-day. Here we are, this big black line, 200-day. And in 2015, this was also a place where we stalled and rolled over. And so everything looks bullish with the exception of the fact that we're right around this 40-week moving average and need to pay attention to that. And then if we go to the DAX, we have the same thing. So trying to hold around the 200-day moving average. And again, is the line an exact science? No, but it gives you an area to keep watching. And so we break out, and you can see even back here, we broke out for 3 weeks and then gave it right back again in April. And that was a good clue. So my point would be that the advanced decline line data has enough gaps in it that it's starting to look significant. The New York one does not look like it has a gap in it, but the trend lines are in place. So be careful. And overall, just with the bond market, it makes me very worried. So thanks for taking the time to join me on Market Buzz. Market Buzz airs live Wednesdays and Fridays at 10:30 a.m. Eastern and 7:30 Pacific time on Stock Charts TV. Thank you. Here's how to add a moving average onto your indicators. Scroll down to the indicator section and use an overlay, picking simple moving average. Then you can specify the period, and if you use a colon symbol, you can also pick the color that you want to go with it, and then that'll place that right on top of your indicator like that.